Hi, this is Kurt Kringelis, Head of Credit Strategy for Voya Investment Management. I would like to take a few minutes to share with you a brief update on the performance of the fixed income markets. 2014 ended on a negative note as the weakness in oil prices continued to inflict pain on the credit markets. A brief rally occurred over the holidays as oil prices stabilized, but the trend towards wider spreads resumed in late December. As might be expected, the high yield and emerging markets suffered the most severely. Securitized markets are relatively immune to the impact from lower oil prices, and they managed to post a slight positive excess return for the month. Only the securitized and government-related sectors delivered positive excess returns for the year. Within the U.S. investment-grade corporate market, the string of negative excess returns continued for the fifth consecutive month, the longest string of negative excess returns since a QE-related taper tantrum in the third quarter of 2013. The commodity-related industries once again responded poorly to the further declines in oil prices and pulled the rest of the market down. Only the utility industry managed to deliver positive excess returns for the month. The market did attempt a modest rally in the fourth week of December as equity prices soared and oil prices stabilized. However, the sell-off in oil and credit spreads resumed during the final week of the year. On a year-to-date basis, the communications, financial, and technology industries were the notable outperformers. The commodity industries performed the worst in response to sharply lower commodity prices. From a longer-term perspective, it is notable and encouraging that the financial industry exhibited its traditional safe haven status and illustrates the progress that has been made in restoring the health of the industry since the financial crisis in 2008. Idiosyncratic factors helped the communications industry perform well. Industry performance across the middle of the market was influenced in part by the duration characteristics as long bonds significantly underperformed the overall market. Spreads widened again in December as lower oil prices pulled the market wider. In the near term, the oil price direction and international developments will probably have more influence on market direction than U.S. economic strength. The release of earnings has often been a positive catalyst for the market. Earnings will likely beat lowered expectations, but the focus will be on the impact to the 2015 outlook from lower oil prices and a stronger U.S. dollar. Valuations are relatively attractive, and the odds favor longer-term spread tightening and a continuation of the credit cycle, but Fed uncertainty remains a medium-term overhang that could also keep spreads range-bound in the short term.